Welcome to this educational presentation about recourse and non-recourse debt in partnerships, and how these rules affect partners' basis and at-risk limits. This material is provided for educational purposes only and should not be taken as tax or legal advice. Always consult a qualified CPA or tax professional for your specific situation. In a partnership, the classification of debt directly affects each partner's tax basis, the measure of their investment in the business for tax purposes. A partner's basis determines how much loss they can deduct and whether distributions are tax-free or taxable. Recourse debt means that one or more partners are personally liable for repayment. If the partnership cannot pay, the lender can pursue the partner's personal assets. Because of this personal liability, recourse debt increases both the partner's tax basis and their at-risk amount. Common examples include credit card balances, vendor payables, partner loans, and bank loans personally guaranteed by partners. Non-recourse debt means that no partner is personally responsible for repayment. The lender's only remedy is to take back the collateral, usually the property or asset financed. Since no one bears personal loss, non-recourse debt increases basis but does not increase the at-risk amount. Examples include real estate loans secured only by the property and equipment financing without partner guarantees. A special category, qualified non-recourse financing, applies mainly to real estate activities. It must meet all of the following conditions. The loan is secured by real property used in a business. It is borrowed from a qualified lender, such as a bank or government agency. It directly relates to the property activity. It is not from a related party or the property seller, unless that lender regularly makes such loans. Qualified non-recourse debt counts for both basis and at-risk purposes, even though it is non-recourse. Examples of how liabilities are classified: credit cards and vendor payables are recourse. Government tax liabilities are recourse. Real estate mortgages from a qualified bank are qualified non-recourse. Equipment loans secured only by equipment are non-recourse. Each partner's tax basis includes their share of the partnership's debt. Recourse and qualified non-recourse debt both increase basis and at-risk amounts, allowing loss deductions. Regular non-recourse debt increases only basis, not at-risk, limiting how much loss the partner can deduct currently. The at-risk rules under the Internal Revenue Code limit losses to the amount a partner can actually lose. A partner is at risk for cash or property personally invested, recourse debt personally guaranteed, and qualified non-recourse real estate loans. Any losses exceeding that amount become suspended until the partner increases their at-risk investment. These classifications determine what appears on Schedule K. 1. Specifically each partner's share of recourse, non-recourse, and qualified non-recourse liabilities. They directly affect each partner's ability to deduct losses and avoid disallowed or suspended deductions. Accurate classification ensures compliance and prevents errors that could trigger IRS issues. In summary, recourse debt, partner is personally liable, increases both basis and at-risk. Non-recourse debt, secured only by property, increases basis only. Qualified non-recourse debt, real estate loan from a qualified lender, increases both basis and at-risk. These rules determine how much loss a partner may deduct and help ensure accurate reporting of partnership liabilities. This video is for educational use only and does not constitute tax, accounting, or legal advice. Always consult a licensed CPA or tax professional before making tax decisions.